today I want to talk about Netflix and why it may not be as pricey as many think. Now, this video goes along with an article I wrote on Seeking Alpha. So if you haven't read it already, go ahead and check that out. Now, like many, I have not given Netflix a whole lot of thought. The price to earnings ratio, when I looked at that thing, I mean, for the last forever, it's been, way north of 100. Right now, if the 12-month trailing PE is almost at 200, and the forward PE, over the next 12 months is still over 80. And so for a lot of us, especially value-oriented investors, we look at that and we struggle to kind of buy something with those multiples. But I recently did a discounted cash flow analysis on Netflix to really see, what am I missing here? Because I think it's good for all of us as investors to learn and try and figure out what maybe the market's trying to tell us. And when I did a DCF analysis, I was actually quite surprised. And initially when I did this last month, the stock price had not risen as much. I think it was trading in the 170-ish range. And so actually at that point, I thought, it's actually a pretty good buy. Since then, it's come up, now it's between 190 and 200. And as I'll explain, I think it's fairly valued around here. My fair value for the company is $188 a share. And you can see that down here, this $187.95, basically $188 a share. So I just kind of want to walk through my DCF analysis and kind of provide a little more detail than the article I wrote on Seeking Alpha provides, and kind of how I came up with my assumptions. So if you look here at this revenue line, I'm assuming revenues will grow at about an average of 19% a year over the next 5 years, which is more front-loaded. So I believe this is kind of a summary page, but the details of my model show like a 25% revenue growth in 2018, and then kind of dipping down, and then it kind of stays at about 15% in years 3, 4, and 5. But on average, it's a 19% growth rate. And then from years 6 through 10, I have the growth, an average growth of 7.41%. But again, that's kind of front loaded. So the growth is slowing, which is what you see from most companies. I mean, companies can't grow at high rates forever. So still solid growth all around, I think. And then eventually after year 10, I've got just the 2.35%, which is the 10-year Treasury bond rate, just grow at kind of the rate of the economy. So total 10-year change of about $26 billion. Now, the revenue growth will come from subscriber growth, obviously, but also as Netflix kind of recently clarified and reiterated that they plan to slowly and steadily raise prices, the monthly subscription price over time. I know at least, my bill, I think we started at $7.95 a few years ago, and it keeps on creeping up. But as a consumer, you don't mind so much your bill going up 50 cents a year. 50 cents a month, I guess, every year. So anyway, keep that in mind. And that's actually what kind of sparked me doing this analysis, is like, well, maybe a lot of people aren't thinking about how much they could hike the prices over time. And I'm really, in my article, I talk about, I do think that this number is reasonable. As you can see, I have my revenues going from currently, next year, $13.6 billion, all the way up to about $37 billion in the terminal year, 10 years from now. And I kind of wanted to do an analysis to see if that was actually reasonable, given kind of the world population, the household population of the world. And I talk about this in the article and show that if you look at the top 35 countries in the world, they've got about 1.5 billion households. So households is going to be less than population, right? Because you got, average of 3 or 4 people per household in most of these countries. And usually you only have one Netflix subscription. At least I know I do. I only have one Netflix subscription for my family. And so really kind of that's maybe the upper limit is about 1.5 billion subscribers, household subscribers. Currently, let me just flip over really quick to this slide. This is from the latest earnings report. You can see down here total membership. Right now, as of the end of Q3 2017, there's about 105 paid members, 110, 109 total members, because some of those are on free trials. So right now, that's where we're at, is 105-ish, let's say, paid members. I think based on, let's say, a maximum, if they got every household in the world, at least those top 35 countries, and it doesn't really matter. I mean, if you look at the top 95 countries, you only get to 1.6 billion households. So, I think if we look at that number, also, China is about 500 million households. So if we extract China, because I do think Netflix is going to struggle with China. I think there's bigger players, Alibaba, Tencent, these other big pocketed companies that are getting into this streaming space, and I'm probably missing some. So I really think Netflix will not be able to penetrate China. So I'm just excluding China completely from consideration, and you're still left with 1 billion households worldwide right now, and the population of the world is still growing. So I assumed, I think actually Netflix could get 25% of that over the next 10 years. If you think about it, that the United States, we've got about 133 million households. Netflix in the United States, if we go back to this, you can see, oh no, this doesn't show it, but there were 56 million subscribers in the US as of Q3 2017. So we're already approaching the 50% of household population in the United States, and I think we'll eventually get there. I don't know if we'll get to 50% of household in all of the top 35 countries of the world, but I think you can get to 25%. And if you get to 25%, and like I said, there's 100 billion households excluding China in those top 35 countries. So 25% of 1 billion is 250 million. So I think realistically, you could get to 250 million subscribers. And when you do the math, as I explained in the article, if you think an average of $12 per subscriber, right? $12 a month per subscriber, then that means if you have 250 million subscribers, that equates to $3 billion in revenue a month. And times that by 12 months of the year, that is $36 billion a year. So that gets us right around the number that I kind of have in my DCF at the end of this 10-year period, around the $37 billion mark. So enough with that. Let's kind of get a little bit further into this valuation. We spent a lot of time on revenue. Operating margins right now. Operating margins, and I've got mine slightly adjusted, and there's actually more adjustments that you can make that may make for a better discounted cash flow. But I did capitalize the R&D expense, so I treated that. I changed that from being an operating expense to being a capital expense, and so that made the margins slightly higher than they really are. Because I think R&D really should be treated as a capital expense, and then depreciated and amortized over, I estimate, a 5-year period. So, and you could do the same with content costs, right? You can treat that as really, and I have a slide here. Let me see if I can. So right here, you can see their content obligations are about 17 billion as of the end of September 2017. So that means they kind of have contracts to license. I think most of it's licensing. Some of it could be their own production costs, but they have obligations, commitments over the next. This shows, over the next 5 years and more, but the bulk of it's within the next 5 years. And in this next year, for example, they have almost $7 billion already. And we know, Netflix has said they're going to spend $7 to $8 billion next year on content, which seems to be kind of the run rate right now. But if you treat that $17 billion in total content obligations as debt, and then so you take that out as being an operating expense, and then treat it as just a financing type thing, then your DCF will look different. But I actually ran those numbers, and the valuation I came back with was around the same as this $190 range for the value of the company. But anyway, so I think the way that I have it set up in this DCF, I think the margins can grow, from this kind of 10, 11% level right now, all the way up to 37% in year 10. And if you look at that, that's actually, I think I have another slide here. That's about you see this 38% contribution margin down here. Oops, go back. So the United States operations are already hitting that margin profile. And so I think it's reasonable to assume that the rest of the company can. International, and this slide here, you can see at the bottom there, contribution margin is 3%, which has improved a lot since last year, which is negative 11%, right? And U.S. operations also improving slightly. So I think over time, as there's more and more international subscribers to spread these kind of fixed costs over, then you get the operating leverage and the margins should go up. So I don't think it's unreasonable to assume that eventually, 10 years from now, Netflix could be running at a 30% or 37% operating margin. And tax rate, I'm assuming kind of a straight 30% tax rate, which may be too high, could be too low. It's kind of, so that's kind of a swing factor as well as what happens with corporate taxes in the United States. I know that's currently up for debate and in flux. So I think 30% is a reasonable level. And then we kind of get through. So you see right here how my operating margins actually increase over time. And then that shows the EBIT, the operating earnings, based on that operating margin over time. And then the EBIT times, 1 minus tax rate. So after tax operating earnings here going up to almost 10 billion by the end of this 10-year period. And then net reinvestment. So I really used a sales to capital ratio, which means, kind of historically for every dollar increase in the sales, what capital do you need, right? And so I think, Netflix can increase their sales $1.3 for every dollar of capital that they put into the business, reinvest back into the business. And I think that can go up over time. I kind of have that going up to this level of 2, which I think with the operating leverage as well, you'll kind of get more bang for your buck. And so using a sales to capital ratio, I came up with this net reinvestment, which is how much Netflix has to, of the earnings, Netflix has to put back into the business to cause it to grow, right? Because growth is not free, rarely ever free. You've got to spend money to make more money. And so to grow revenues, you've usually got to spend more money. And so this is actually above and beyond depreciation and amortization. So even though you're amortizing, depreciating certain costs and therefore have to replace them, so you're going to have CapEx to replace those. this reinvestment I'm talking about is above and beyond just the replacement capex. Okay, this is growth capex, and so you've got to subtract out that reinvestment to get to your free cash flow. And so this is kind of the free cash flow I have going over the next 10 years. You see I'm still showing negative free cash flow, which I think Netflix management has said it will be negative for a little while still. But in a couple of years, 2-3 years, I think it will turn positive, and then just as margins expand, ramp up dramatically to running at a $8 to $9 billion run rate, kind of at the end of this 10-year period. And so, for a company that's trading, currently the market cap like 85 billion or whatever, if there's a clear path to achieving 8-9 billion in free cash flow within the next 10 years, that effectively is a 10% free cash flow yield in 10 years. That's fairly attractive, especially in the current interest rate environment, right? And so down here, when you kind of take do a terminal value equation on that. Whoops, sorry about that. Get back there. On that end number, $8.2 billion number there, you get a terminal value of 145 billion. Present value of that, 67.5 billion. The total value of the cash flows over the next 10 years, 36 billion, but discounted is about 19.6 billion. So add those together. Total value of the operating assets, right? Total value of the firm, the enterprise kind of value, 87 billion. But then you've got to back out the debt and add back cash. So net debt, they do have a net debt. You get down to this $84 billion number, and then divide that by the number of shares, gets you the roughly $188 a share. So I think right here, shares are fairly valued. I don't know if I'd quite pull the trigger. I'm inclined to wait for a pullback, especially below like 150. It starts to look really attractive to me. But as I explained in the article, I think competition is only intensifying, and Disney, has recently announced their plans to pull out of kind of the Netflix ecosystem and create their own thing. I think others could follow, and Netflix will be more reliant on its original content. And so I think there's some execution risks there on this transition from kind of a lot of licensed content to more of kind of their original content. And I think a lot of the big media companies, as well as like Apple and Facebook, have kind of expressed their interest in doing their own original content. So I think there's going to be quite a bit of competition. So that's the thing that keeps me from pulling the trigger right here. And so to the extent you get more clarity on that and how that plays out, and Netflix kind of dominance in this space, then maybe you'd be more inclined to buy it at these prices. But even if you did buy at these prices, if these assumptions play out how I have laid them out, I used an 8% discount rate. And so what that means, if you bought it at fair value, you can kind of expect an 8% return on average per year, and that's not too shabby given where things are right now. But if there's a pullback in the general market and this goes down with it, it may be somewhat attractive. But the point of my article and point of this video is that Netflix isn't actually as expensive as people thought. And I think a year ago, if you would have looked at the numbers of Dcf Analysis, and you came to kind of the same conclusion that there'd be 250 million subscribers 10 years from now, and that prices would be hiked kind of regularly over time, I think you could have gotten to this conclusion, and you could have made some money, back when the stock was trading at, $100, $130 range. So anyway, that's it for this video. I'd love to hear your comments. Sorry this went a little bit long today. We hope to do a lot more of these and cover different companies. If there's a company that you would like me to look at and do a video on, please let me know in the comments. All right, till next time.